Bitcoin fell below $6,400 overnight, but has subsequently rebounded to 6,471. But there's been some very interesting commentary that's come out. Bitcoin's remarkable run last year may have been smoke and mirrors. Tether, and I must give credit to Nouriel Rubini, who alerted me to this a long time ago. Tether, another digital currency tied to the US dollar, has been used to artificially inflate Bitcoin prices, according to a study released Wednesday by the University of Texas. John Griffin, a finance professor at the university, and graduate student Amin Shams analyzed blockchain purchases and discovered that major Tether buys were timed to follow market downturns and helped stabilize Bitcoin's floor. These patterns cannot be explained by investor demand, they said in the study. You will recall at the beginning of 2017, I recommended Bitcoin as my trade of the year. And then 27th of November 2017, I told everybody to take profit. I said my investment thesis at the start of the year was that Bitcoin was going to get mainstreamed in 2017. And I said it is mainstreamed beyond my wildest dreams. Therefore, I am now sidelined. And I quoted Hunter S. Thompson, "Life should not be a journey to the grave with the intention of arriving safely in a pretty and well-preserved body, but rather to skid in broadside in a cloud of smoke, thoroughly used up, totally worn out, and loudly proclaiming, 'Wow, what a ride.'" And then looking at the price, it rallied 1,400% in 2017 amid an investor frenzy for digital assets, and down almost 70% from its record high set in December. This study from the University of Texas at Austin all but confirms Tether is manipulating Bitcoin. They took an in-depth look at the secretive and suspicious cryptocurrency issued by Bitfinex called Tether. The abstract for the paper succinctly describes what the paper is about. The paper investigates whether Tether, a digital currency pegged to US dollars, influences Bitcoin and other cryptocurrency prices during the recent boom. Using algorithms to analyze the blockchain data, we find that purchases with Tether are timed following market downturns and result in sizable increases in Bitcoin prices. Less than 1% of hours with such heavy Tether transactions are associated with 50% of the meteoric rise in Bitcoin and 64% of other top cryptocurrencies. The flow clusters below round prices induces asymmetric autocorrelations in Bitcoin and suggests incomplete Tether backing before month ends. Patterns cannot be explained by investor demand proxies, but are most consistent with the supply-based hypothesis where Tether is used to provide price support and manipulate cryptocurrency prices. First, if the Tether founders, like most early cryptocurrency adopters and exchanges, are long on Bitcoin, they have a large incentive to create an artificial demand for Bitcoin and other cryptocurrencies by printing Tether. Similar to the inflationary effect of printing additional money, this can push cryptocurrency prices up. Second, the coordinated supply of Tether creates an opportunity to manipulate cryptocurrencies. When prices are falling, the Tether creators can convert their Tether into Bitcoin in a way that pushes Bitcoin up, and then sell Bitcoin back into dollars to replenish Tether reserves as Bitcoin price rises. Finally, if cryptocurrency prices crash, Tether creators essentially have a put option to default on redeeming Tether, or to potentially experience a hack where Tether or related dollars disappear. This is one of the simplest and digestible explanations on how Tether possibly affects the price of Bitcoin, by creating artificial demand for Bitcoin, by printing more tethers. Like a yo-yo, when Bitcoin falls, they can sell tether for Bitcoin, which drives the price up. When it goes up, sell it for tether again. It's a form of money laundering when you think about it. The flow goes like this. Tether is created. Tether is then moved to Bitfinex. Tether is slowly moved out to other crypto exchanges, mainly Poloniex and Bitrex. No tether ever returns to the tether issuer to be redeemed, and the only exchange where tether can be exchanged for dollars is Kraken, which, as you can see, accounts for a small portion of transaction volumes. Things really start to get interesting when the research focuses on the data and price movements with a more fine-grained microscope. To illustrate the potential magnitude and predictive effect of tether issuances on Bitcoin prices, we focus on the hours with the largest lagged combined Bitcoin and tether flows on the two blockchains. These 87 hours have large negative returns before the flows, but are followed by large return reversals. These 87 events account for less than 1% of our time series over the period from the beginning of March 2017 to the end of March 2018. A bootstrap analysis with 10,000 simulations demonstrates that this behavior never occurs randomly. Zero hedges piling in crypto collapse accelerates as Bitcoin miners turn cash flow negative. I've looked at a lot of markets. If there's fraud or manipulation in a market, it can leave tracks in the data. The tracks in the data here are very consistent with the manipulation hypothesis. Zero hedge. So, there you have it. And I think it's a prima facie case.